Forget about predicting the market. What if we learn to see it in cycles? Let's start our journey in the city of London, back in the mid-1980s. This was a world before instant trades. Prices were shouted across trading floors by guys in bright jackets called blue buttons. If you wanted data, you had to physically go to the Bank of England and collect it. Even having one of those clunky early mobile phones gave you a massive edge, but everything was about to change. In 1986, the Big Bang hit London. Face-to-face trading was replaced by electronic screens, and trading volumes exploded. It felt like finance was reinventing itself overnight. But markets don't exist in a bubble. At the same time, the world was being reshaped. We had the rise of personal computers and the first whispers of the internet. Politically, leaders like Thatcher and Reagan were pushing free market reforms. The Soviet Union was opening up under Gorbachev, and China was creating its first special economic zones. It was an era of incredible optimism. People felt less risky, and that optimism fueled a massive stock market rally. But cycles always have a dark side. After a huge run-up, reality hit hard on Black Monday in 1987. The Dow Jones crashed spectacularly. It was a classic moment of cycle violence. Yet something different happened this time. Central banks, led by the U.S. Federal Reserve, stepped in with decisive force, flooding the system with liquidity. The market recovered far faster than it did after the 1929 crash. This taught us a powerful lesson. At major turning points, central banks often become the most important player in the game. We saw it again in 1992 on Black Wednesday, when the UK was forced out of the European exchange rate mechanism. It was another moment of extreme stress, followed by a major policy shift that ultimately paved the way for recovery. Whether it's through interest rates, printing money, or just powerful speeches, central banks can completely change the market's direction. But here's the real takeaway. Forecasting is incredibly hard. It's not because economists aren't smart. It's because the market is a complex system full of human beings and feedback loops. Think about it. Our ability to forecast the weather has improved dramatically with better technology. Yet economists still consistently fail to predict recessions. Remember the famous story of the weatherman Michael Fish who told the UK not to worry about a hurricane just hours before a massive storm hit? That's the kind of humility we need when thinking about the economy. So, the goal isn't to stop thinking, it's to think differently. Forget precise point forecasts. They're almost always wrong. Instead, we can get an edge by learning to recognize the signs of excess. Are people euphoric, or are they terrified? Are we near a peak or a trough? Avoiding the biggest losses and being ready for the early days of a recovery is what truly drives long-term success. This is where psychology comes in. Standard economic models often ignore our very human tendency to follow the herd. In normal times, we're cautious. We protect what we have. But near the extremes of a cycle, we flip. We get hit with FOMO, the fear of missing out and pile in at the top, or we panic and sell everything at the bottom. These emotional swings are what make booms overshoot and busts undershoot. This creates a weird dynamic called reflexivity. The market's expectation of a recession can actually cause one. If everyone sells stocks and credit markets freeze up, businesses can't get loans, confidence evaporates, and the economy grinds to a halt. This is why policymakers are now obsessed with financial conditions. The market's mood has become a part of the economic reality itself. This puts central banks in a tough spot. It's hard to prove a bubble is a bubble while you're in it. They hesitate to act, not wanting to second-guess the market. And so, cycles can run much further than anyone thinks is rational, until suddenly, they can't. So, here's the practical stance. Despite decades of change, the rhythm of cycles repeats. You might not know the exact date or time, but you can learn to spot the weather patterns. You can see when the sky is getting cloudy and when the sun is starting to break through. Now, let's connect this idea of cycles to the actual math of investing. What kind of returns can we realistically expect over the long run? Looking at historical U.S. data, stocks have delivered around 10% average annual returns. In contrast, 10-year government bonds have averaged about 5 to 6%. The basic lesson is simple. Over time, taking on more risk has generally been rewarded. But that reward comes with a price: volatility. In the short term, stocks swing around far more than bonds. This is why bonds feel safer. However, something amazing happens as you extend your time horizon. The volatility of stocks starts to compress. The chances of losing money over a multi-year period drop dramatically. This supports the idea that for long-term investors, the scariest moments in the market are often the best opportunities to buy. But we have to be careful with averages. They hide a lot. Your starting point matters immensely. If you bought stocks at major peaks like right before the 2000 tech bust or the 2008 financial crisis, your returns over the next decade were likely pretty disappointing. But if you bought at the bottom of a bear market, when valuations were cheap and fear was everywhere, your returns were probably fantastic. Bonds had their own once-in-a-generation story. If you bought U.S. Treasuries in the early 1980s, when inflation was raging and interest rates were sky-high, you made incredible returns for decades as both fell steadily. The returns were so good, they looked more like stock returns. It was a massive tailwind that simply and be repeated from today's much lower interest rate levels. This makes our job as investors today much harder. This brings us to the equity risk premium. It's the extra return you expect to earn for taking the risk of owning stocks instead of safe government bonds. This premium isn't fixed. It moves with investor confidence and uncertainty. Historically, this premium has been surprisingly high, something researchers call the equity premium puzzle. It suggests that either investors are more risk-averse than we thought, or that past returns were inflated by rising valuations. And valuation is the bridge that connects everything we've talked about, connects the psychology of cycles with the math of returns. One of the best tools for this is the Shiller-Cape ratio, which smooths out corporate earnings over 10 years to give a clearer picture of whether the market is cheap or expensive. What it shows consistently is that your starting valuation is a powerful predictor of your future long-term returns. When the CAPE is extremely high, the following decade tends to be disappointing. When it's extremely low, the following decade tends to be great. We also can't forget the quiet engine of compounding. Price charts alone are misleading. Over the long run, a huge portion of total stock market returns has come from dividends and reinvesting them. More recently, companies have been returning cash through stock buybacks, but the principle is the same. It's the slow, steady compounding of these returns that truly builds wealth. So let's bring it all together. No one can perfectly time the market, and you shouldn't try, but you don't have to. The data is clear. Missing the market's best days can destroy your long-term performance, but avoiding the worst days can massively improve it. And here's the key. The worst periods tend to cluster around specific parts of the cycle recessions. Periods of aggressive policy tightening and high valuations. The best periods cluster around the opposite. Economic recovery, policy easing, and cheap valuations. The practical edge isn't about predicting the next headline. It's about respecting the cycle. It's about understanding what kind of environment you're in, high sentiment or low, expensive or cheap. By doing that, you can tilt the odds in your favor and navigate the inevitable booms and busts with confidence. Thanks for watching. If this helped you think about markets in a new way, make sure to like and subscribe for more. See you next time.